Hey, welcome back, options traders. And I got a good post in our Facebook page here a couple of weeks ago from one of our traders asking if I could do a series on managing a broken wing butterfly. And I said, sure, I think it's a great topic. But then it got me to thinking, I have a feeling what this person is asking about is how do I manage my way from a losing trade? And the reason I think that is pretty much every time that somebody asks me about managing a position, they're trying to find out how can I wiggle my way out of a losing trade. They're not looking at it from the risk management side. How do I manage the risk so that I don't get myself into a loss that's too big to be acceptable? But the bigger issue is that people think they can manage a losing trade. Well, is that even possible? Can you manage a losing trade? Let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So the first thing to understand as a trader, each trade stands alone. That is critically important as a trader. Opening or closing positions just overlays a new position on top of the current one. Now, yeah, because we have this man-made rule that you can't be long and short the same option in the same account at the same time, it looks like you're altering things, but you're really just mathematically layering a bunch of trades on top of another one. And that might actually increase the potential loss. So you're not managing your way from a losing trade. You're entering a new trade to hopefully reduce the loss of the original trade. And that's a very different reason for entering that position. So for example, let's say that you are long the ABC May $100 call and you want to roll it up. So you place an order to sell your ABC May $100 call and simultaneously buy the ABC May 105 call. Now that combined is a vertical spread. You can enter it as one trade on your broker's platform. It would be a short vertical spread. You are selling the 100-105 vertical. But notice when you do that it cancels your long and you're just left holding the May 105 call. So it looks like you've swapped out or rolled from the 100 call to the 105. And that's true, but mathematically, all you've done is you're still holding on to the May 100 call and you just put on a vertical spread. You just sold a vertical spread. See, because the OCC doesn't allow you to be long and short the same option in the same account at the same time, they're going to close these. They're going to say that's a closed position, because if they didn't, it would just throw off the open interest. It would look like you've got two brand new positions here, and you don't. One is closed. But mathematically, it doesn't really matter. We could say that you're still holding the May 100 call, and you're also holding a short vertical spread. See, so you would be long and short, and effectively would just be long the May 105 call. But again, don't let that fool you. Understand that you are just overlaying a short vertical spread on top of this one. Can a short vertical spread lose money? Yes, it can. Can your May $100 call lose money? Yes, it can. So all you've really done is you've put a second position on here that might increase the losses. But it looks like you rolled up from the 100 to the 105. Now, don't misinterpret this to mean that you shouldn't roll. I'm a big fan of rolling, but for the right reasons. What I'm trying to show here is that if people think that they're trying to get out of a losing position by rolling an option, all you're doing is overlaying a new position on top of the old one. All right, what if you wanted to instead roll out a position? Let's say you wanted to roll your calls out. Now, traders often roll their long calls or puts early to avoid time decay. This is another big misperception. So for example, let's say that you're long this ABC May 100 call, and so you're getting close to expiration, or at least relatively close. Maybe it was a 1-year option, and now you're within a couple of months, and you're saying, well, compared to the year that I used to have on it, it's getting too close to expiration. Let me roll it. Or maybe it's a 30-day option, and it now has 15 days. And you're saying, well, it's getting close, let me roll it. And the reason that traders do it is because they're trying to avoid time decay. So look what happens if you do that. If you place an order to sell the ABC May 100 call that would be this option right here, and simultaneously buy the ABC June 100 call, what is this over here? You can place that as a single order in your broker's platform. That is a long calendar spread. So ask yourself, can a long calendar spread lose money? Yes, it can. Can your long 100 call lose money? Yes, it can. See, you now have a second position on here that could lose money. But it looks like you've rolled out and are somehow pulling a fast one on the market that you're not going to experience as much time decay. It looks that way because the OCC is going to close those out. But again, don't let that fool you. That's a man-made rule just to assist with tracking open interest. Mathematically, you have a long 100 call and you have a long calendar spread. So let's see why this is not going to allow you to avoid time decay. So here's a list of option prices from a pricing model, 30 days to expiration, $100 call worth $229. And they gradually get cheaper. That's our time decay right there. At the halfway point, the option is worth $1.62. So most of you know, we've talked about this many times with the square root pricing rule. At the halfway point, 15 days out of 30, the option will not lose half of its value. Going to lose roughly 30%. And it's going to be trading for $1.62. And then it's going to start going off of a cliff and start decaying faster. And again, this is why people think, oh, I need to roll my long call. I don't want to watch it go off a cliff. But look what's happening. Let's say that you bought this call for $229. All right, so you're out $229. Some time goes by and you're at the 15-day mark and you say, oh, let me roll it. And again, here's the logic. It's worth $1.62 now, and if I continue to hold it, I'm going to lose $1.62. All things being equal, assuming the stock price stays the same. And you're thinking, well, why should I expose myself to another $1.62 loss when for another 67 cents I can roll to, let's say, another 30-day option? And instead of having it go to zero, it'll just fall from $229 to $1.62. So instead of holding one option for 30 days, I'm holding two 30-day options, but only for 15 days. And so it looks like you're avoiding time decay. So here's the roll. We spent $229. 15 days later, we spend 67 cents to roll it. Now again, that roll is coming from, we're going to collect $1.62 from our current option, but the new 30-day option, assuming these prices stay the same, will cost us $229 for another 30-day option. So on a net basis, we spend 67 cents. And so again, it looks like you're going to avoid time decay. Instead of losing this full $1.62, you're just going to lose this difference right here from $229 to $1.62, or just 67 cents. Well, look at what happens. Notice that when you spent $229 for the first option, you've now spent an additional 67 cents. So in total, you've spent $296. So if both of these trades, even though it doesn't look like you have two trades on, you're long a call and you're also long a calendar spread. If they both go against you, you could lose $296. However, in 15 days, you're thinking, I'm going to get $1.62 back. It's not going to be down here at zero. I can sell it for $1.62. And if I do that, I'm only out $1.34 instead of $1.62. In other words, I would be better off by 95 cents. And this is the illusion. Traders think by spending 67 cents, they're going to avoid this $1.62 loss. And therefore, they're better off by 95 cents. But again, we have to break it down and look at these as overlays. What is this roll right here? That is a calendar spread. What is this calendar spread right here? Why are we better off by 95 cents, assuming the stock price doesn't rise? Well, let's go back to our time decay curve. If we were to graph all of these prices right here, we would get this curve. There's our $229 price with 30 days. So at the halfway point, we know that it's worth $1.62. So let's say that you bought a calendar spread. Don't look at it as though you're rolling the option. We're just going to buy a calendar spread. you're going to spend $2.29 for the long. You're going to collect $1.62 for that 15-day option. So on a net basis, you've spent 67 cents. And what's it going to be worth in 15 days? In 15 days, the short position goes from $1.62 all the way to zero. So there's nothing you need to do there. It just expires worthless. You're up $1.62 on your short position. However, your long position has decayed a little bit because it's now worth $1.62, right? It's gone from $2.29 to $1.62. So again, you've just lost 67 cents. So on a net basis, right there, you have collected 95 cents. That is simply the profit from the calendar spread. So you've got a 95-cent profit. Well, where did that come from? Was it anything magical? Should we have expected it? Well, it's exactly what you should expect based on this square root pricing rule. We know that a 95-cent profit relative to the 67-cent cost is an increase of 41% on your money. And where is that coming from? Because the option you bought has 2 times the amount of time. That's just the reverse of the square root pricing rule. The one that we bought has twice as much time, so we're going to have a 41% profit, all things being equal. But look at that 95-cent profit. See, that's exactly what the first trader thought he was saving by rolling. Well, he didn't save it. He just put on a calendar spread, and if the calendar spread worked out, then he would be better off by 95 cents. But if it doesn't, then he's out by 296, as we saw before. So see, this is just very simply a calendar spread put on top of a long call, but it looks like you're avoiding time decay. And that is one of the biggest myths, one of the biggest illusions that traders fall into. One of the most common questions that I get, where traders say, how do I manage my way out of this? I don't want to experience time decay. Should I roll it? And that way I'll be better off by 95 cents. You're just placing a second strategy on top of your first one. So don't try to manage your way from time decay. Time's going to pass whether you do anything about it or not. And that will all get reflected in the prices of the strategies. Instead, the reason for putting on a strategy is because there's some type of edge, not because you're trying to fight your way from a losing position. So if we look at this calendar spread right here, this is our risk graph. We're long the 30-day, short the 15-day. And look at that. There is the maximum profit right there at 95 cents, and there is the maximum loss at 67 cents. So if you go back to the original idea where this trader was trying to roll early to fight time decay, what was the price of the roll? 67 cents. What was he better off by? 95 cents. Now you see what happened. The long call expired worthless, and his calendar spread came to the rescue and made 95 cents. But it looks again like you're pulling a fast one on the market and somehow avoiding time decay because you rolled your option early. So before we even get into managing broken wing butterflies, I want to make this very clear that you're not avoiding losses. You're not becoming better off or necessarily worse off. You're just putting on new strategies. It's either because it's an opportunity, there's some type of an apparent edge, or it's because you're trying to manage risk. But you're not trying to manage your way from a losing trade, because that can never be done. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.